Hey, crypto traders. Ever wondered what that squiggly line below the price chart is that traders often use? Today, we're demystifying the Relative Strength Index, or RSI. We'll give you a simple animated explanation of this key trading indicator. Let's dive in. What is the RSI? The Relative Strength Index, RSI, is a momentum indicator used in technical analysis to evaluate overbought or oversold conditions in the price of a stock or other asset. Essentially, it measures the speed and change of recent price movements. The RSI is an oscillator, meaning it moves between two extremes, 0 and 100. Overbought and oversold levels. The key levels to watch on the RSI are generally 70 and 30. When the RSI goes above 70, it often suggests that the asset might be overbought, meaning the price has risen too quickly and could be due for a pullback or correction. Conversely, when the RSI drops below 30, it often suggests that the asset might be oversold, meaning the price has fallen too much and could be due for a bounce. Using RSI for potential signals. Narrator, besides overbought and oversold levels, traders also look for divergence between the price action and the RSI. For example, if the price is making higher highs, but the RSI is making lower highs, this could be a sign of bearish divergence, suggesting a potential downtrend. Conversely, if the price is making lower lows, but the RSI is making higher lows, this could be bullish divergence, hinting at a possible uptrend. The RSI is a valuable tool for understanding momentum and potential turning points in the market. Remember that no single indicator is perfect, so it's often best used in combination with other forms of technical analysis. If you found this animated explanation helpful, give us a like and subscribe for more crypto trading insights. Let us know in the comments what other indicators you want us to break down. Thanks for watching.